Hey Bowtie Nation, Joseph Hogue with the Let's Talk Money channel here on YouTube. Going to start doing some quick take videos on Tuesdays and Thursdays. We've got our regular videos on Monday, Wednesday, and Friday still, but I thought this would be a great opportunity to answer some of your questions and cover some of the news that we're seeing around this outbreak and the stock market crash. This is a hugely risky time for investors, and I just want to make sure that you're making the right decisions and really keeping on that path to financial freedom, as we say. So let me know if you like these informal type videos. Don't forget to join the nation, click that subscribe button, and we'll get to it. So what we're going to cover today is the travel and tourism related stocks. Okay, I'm getting these questions from all over, from the Facebook group, from YouTube. How bad can it get? When should I get back into these travel and tourism related stocks? These are really the ones that have been hit hardest by this virus, and how to take advantage of some of these stocks that are down 80, 75, 80, 85%. So we're going to talk about that. We're going to talk about some of the news that we're seeing today and really some stocks to watch, including one that I just checked in my portfolio today, this REIT that is actually up 13% so far this year. Okay, so since January, it's up 13% against the market that's down about 28% so far today. And so that's beating the market by 40%. Couldn't believe it. We're going to talk about this group of stocks that you need to have on your radar. So again, make sure you join the nation, click that subscribe button. I'm actually going to include links to the Facebook group and the YouTube group down in the description below. Make sure you join the conversation on Facebook because we've got surged to over 1,000 members just over the past few days. We're having some really great conversations about the virus, about the outbreak, and some investing opportunities. So again, join the conversation there on Facebook, and let's get to it. So these travel and tourism stocks, right? Some of these are down, like I said, 75, 80, 85%. And it reminds me a lot of the banks, the auto manufacturers back in 2008, 2009. If you were able to get in on those at the right opportunity, right around March of 2009 when the market bottomed, that was, 2, 3, 4-fold returns just over the next couple of years, and then many times your money after that. But I don't want you to think that we're just there yet. Okay, there is still pain to come in these. So I want to talk about how to know how to strategize your investment in these, when to get back in, and some of these things we need to watch for. So now the president has said that he will backstop the airlines and the cruise lines. Right? News conference yesterday, he said he's going to backstop the airlines completely. The problem is we don't exactly know what that means. Okay, we don't know if that's low interest loans or cash payments or what have you. And I also don't want you to think that a bailout is still going to mean there won't be investor losses. Okay, what we saw with the banks in 2009 is they had to dilute their shares so much that it was still quite a while before they reached the peak or the prices where they were before that recession, before the financial crisis. So we could still have that in some of these travel and tourism stocks, even if they survive and avoid bankruptcy or restructuring, which I think some of them will have to restructure. Even if they do that, they still may have to dilute shares, and there's going to be investor losses from this point. So that's why I think you need to wait, even after that guarantee of backstopping, of government backstop or bailouts. So now the point here is going to be with these travel and tourism stocks that I think they can be good investments. I think they can be huge returns, but I would rather you invest a little bit after the bottom than trying to call it and get hit all the way down. Okay, I see a lot of people in the Facebook group or on YouTube calling a bottom out on these stocks. So they jump in each day when these stocks are 10, 20% down. They think that's as bad as it can get. It can't get any worse than this. So of course they push all their money in there. They're all in on these stocks. And I don't, like I said, I don't think the pain is far from over here. So if we look at this chart, and this is from October 2007, so right around the market peak in 2007 through December 2012. Okay, so a few years after that March 2009 bottom. And what we see here is Ford, shares of Ford Motors, that's green. When we have the Citigroup, which is a little bit darker magenta, and then Bank of America, which is that black line. Okay, and then we've got all of this against the S&P 500 index, which is that lighter purple, lighter magenta. So what we see is obviously, these three companies, the bank stocks and the auto manufacturers, got hit hard, much harder than even the larger market, the broader market in that sell-off all the way to March 2009. Now, what we see with Ford is with that Cash for Clunkers program, it rebounded pretty quickly, and all the manufacturers, all the car manufacturers bounced back pretty quickly after that. But it was still upwards of a year and a half, 2 years before it really reached that next peak. Okay, it was still probably about 9 months from the bottom before it reached the prices it had found in 2007 there, where Ford was at that price that it was at 2007. So I don't want you to think that you have to call the exact bottom here. If you were maybe a month or two late into this Ford trade, you would have still made very good money. And if you look at the banks, even more so. The banks bottomed in that March of 2009 and still hadn't reached their prior peak as of December 1st, 2012. Okay, so if you had found, obviously, if you had found that bottom, you would have made some really good money. But it's not exactly like you had to be in at the very bottom of the share prices. Okay, we've seen these bank stocks surge for the last 10 years. And I think you'll see the same in these travel and tourism related stocks. So again, the takeaway I want you to get from this is you don't have to call a bottom. And what I want you to do is make a strategy for investing in pieces, in legs into these stocks. And we'll talk about what to watch for, the stocks that you might want to put on your radar, as well as, when to get back into these stocks. But what I want you to do is start looking at these stocks, and I would actually say maybe wait about a month. Okay, so we're in March, mid-March now. I would say look at these again in April, mid-April, maybe even later April into May, and start analyzing which of these stocks you might want to put in your portfolio. Okay, like I said, I do not think in the U.S. we've seen the worst of the quarantine measures. I think this is going to get much worse. I think they're going to have the police, maybe even the National Guard patrolling, telling people to get off the streets, stay at home, and we're going to see some of the same measures that they have back over in Europe. So Italy, Spain, France, all three of these countries, there is nothing you can do other than go to the pharmacy or go to the supermarket. Okay, everything else is closed. And that's just they have lockdowns on any kind of travel into the country, and I think we're going to see those same kind of measures here in the United States, and so I don't think it's yet a good time to be jumping into these. But what I want you to do is when you're looking at these in about a month or so, and you're using these measures that we're going to talk about here in a bit, then make a strategy. Okay, so if you like some of these companies, and you don't have to invest in all of them by any means, but if you like a company, put maybe 30% of the money that you have available to invest in that stock. Maybe put 30% of it in then. Maybe wait another month, put another 30% in. And then maybe a month after that, put another 30%, okay? Maybe you can even stretch that out even longer. The administration says that the worst of the coronavirus could last through July, maybe August. So I definitely think there's more pain to come on this, and I think you need to spread these investments out. Okay, not only is this going to get you into these shares when you want to. Okay, so in a month and a half, 2 months, then you're going to be looking at these. You're going to put some money into it, and you're going to take advantage of an eventual rebound. But it's also going to save some of that cash back if these shares keep on falling. Okay, it's going to give you that opportunity to buy into dollar cost average in at lower prices if those opportunities become available. Okay, so just kind of a strategy I want you to consider there. And what I want you to do, what you want to watch for in these companies, and really in any time of deep financial stress, you want to be looking at really two things: the balance sheet of a company and its debt payments. Okay, so first the balance sheet. Now this is just one of the three financial statements that the company puts out every quarter and every year, and it really shows its assets, its liabilities, and then what investors owe, right, or what investors own, the stockholders' equity. Okay, and at the very top here, you're going to see the cash on hand, cash on the balance sheet. This is actual cash the company is holding, and this is going to be very important for these companies in the travel and tourism related industries because their sales have shrank to zero. Okay, and as impossible as that seems for a billion-dollar company that is, collecting and booking billions in sales every year, that their total sales, their revenue could shrink to zero. Seems impossible, but it is actually happening. Okay, these companies are in complete lockdown, and they need to be able to pay their operating expenses and their debt, their interest payments with that cash. So you want to be looking for companies that have a lot of cash on their balance sheet, okay? And generally, this is relative to the company size, to the amount of operating expenses and the interest payments they have. So just look for companies that have higher proportions of cash relative to their operating expenses and their interest payments, and I'll talk about where to find those. But that's on the balance sheet. On the balance sheet, you also want to look at that total debt. Okay, so scrolling down on the balance sheet, you'll see another line that says total debt and a number on that. That's the debt that the company is going to owe, and you want to compare that debt to equity. Okay, that's the amount of leverage that this company is using. And what I'm saying here, when you're comparing these, is you're comparing these against other companies, okay, right? So you've got this list of travel and tourism related stocks that we'll cover here in a little bit. I've got about 10 stocks that you can look at. And what you want to do is you want to compare companies to see who is the most financially, the most likely to survive financially, okay? You want to find the companies with the most cash on hand, with the least amount of debt relative to their equity, the most cash on hand relative to their own operating expenses, and those are most likely the companies that are going to survive, and they're going to give you that chance to take the opportunity to get those rebounds in prices when they do come along. So we got the balance sheet, we got the cash on hand, we got the debt to equity. I also want you to look at the income statement where it says interest payments. Okay, that's the amount of interest that these companies have to pay every quarter and every year on that debt. Okay, so what you're going to do, you're going to take the cash on hand and you're going to compare that to their interest payments. Okay, and a lot of times people will take what's called the EBITDA to interest. Okay, and that's just earnings before interest, taxes, depreciation, and amortization. The problem with that is, and you're going to hear a lot of people talking about that, the problem is you don't know where earnings are going to go. Okay, if sales is falling to zero, then those earnings are falling to zero too. So instead, I want you to look at cash and how much cash they have relative to those interest payments, how much cash they have relative to their operating expenses. You also want to look at the debt maturity, and this is very important. This is something you're going to find on the 10K, the annual report of a company. It's going to list out all the loans they have and when those loans come due. Okay, so for any bond a company borrows money, they pay only the interest every twice a year, right? They pay the interest twice a year on that, and then when that bond comes due, when it matures, then they pay that bond back. They pay the face value of that bond back. And that's really where the danger is going to be for a lot of these companies. Okay, you don't want a company that has a lot of debt maturing this year. Okay, because the credit markets are just going to freeze up for these companies. Okay, they've got no sales, so banks don't want to work with them. Investors are going to require huge, ungodly rates for any new loans. So they're going to have to come back into the market and try to get this money. What's going to happen is, one, they're just going to restructure. They're going to file bankruptcy, and these companies are going to go into into receivership or whatever. Or two, they're going to have to dilute shares. This is what a lot of the banks did in 2009. Just massive dilution of shares, so to where the previous investors own very little of the company, and new investors have to be brought on. So definitely you want to look into the 10K of each of these companies, look and see when their debt is maturing, and pick the ones where they have maybe a year, maybe even a year and a half until those major tranches, is what they call them, tranche of debt, come due before they need to pay those off. Now I just want to talk about some of the stocks that you can look at when you're looking at these. Okay, so anything travel and tourism related, obviously the hardest hit in this crisis. So you've got things like the cruise lines. Obviously you've got Carnival, CCL, ticker CCL, and I like this company. This is the largest cruise line. It's a great brand, and ran a pretty good company up until this crisis, obviously, and it hit them hard. Now I hear a lot of people talking about, oh well, the president said he's going to backstop these cruise lines, these companies, but CCL is a British company. Okay, it's actually Carnival PLC. So not quite sure that the U.S. president or the U.S. government would want to backstop or bail out a British company. Maybe there can be some coordination there and help the cruise line, the global cruise line industry. But So you really want to be careful with that one. You've got some other cruise stocks that you can look at, though, Norwegian as well. You've got the hotels. Okay, so Hilton, Marriott, Starwood Hotels. Hilton is ticker HLT. Marriott is ticker MAR. I believe Starwood is ticker HOT. Okay, so again, you want to look for the most financially stable companies with strong balance sheets and no debt maturing as during this year. You've got the casino stocks. You've got MGM Resorts, ticker MGM, that you can look at. I guess most of Las Vegas is shut down. The resorts, the casinos are all closed. You look at the car rental companies. Okay, this is one that a lot of people aren't talking about just yet, but these are actually also very much affected by this. It's affected by the business travel, that kind of thing. So you've got Hertz, ticker HTZ. You've got Avis Rent-A-Car, which is ticker CAR. And of course, finally here, probably one of the hardest hit is the airlines, okay? And the president has said he's going to completely backstop the airlines. We don't know quite what that means yet, but so these could be some major opportunities. But again, you need to be able to know how to get back into these, when to get back into these, and how to pick the right ones. So you've got companies like United Airlines, which is ticker UAL. You've got Southwest, which is ticker LUV, and you've got Delta, ticker DAL. Okay, so that's kind of the strategy that I'm using anyway to get back into these travel and tourism related stocks. Now I want to cover a few of the news points, and this first one is actually really interesting. I haven't seen anybody talk about this yet. I think this is going to be one of the biggest opportunities really in all of this for investors. And it's just the surge in streaming services and other virtual services. Okay, Cisco actually reported 5.5 billion meeting minutes in the first 11 business days of March alone. Okay, and that is huge. That's a huge increase from what they've done in the past. Nielsen actually research estimates that media consumption jumped 60% in these types of major events that cause people to stay indoors. Okay, so streaming providers, obviously people are indoors, they're itchy to entertain themselves, so they're looking for their programs. And now Nielsen did say that people tend to favor news programs as well as serial content. So the kind of thing you get on Netflix actually would be a good opportunity. So I think we're going to see a big jump in a lot of these streaming services, these virtual networking stocks, things like that. And what we've seen so far is these stocks have been brought down with the market. Okay, everything is coming down in this market, regardless of the opportunity in this. But what I think you're going to see is when these earnings reports start coming out for the first quarter, second quarter, third quarter, you're going to see this big bump in sales for a lot of these companies, and I think it's really going to be the driver that drives these companies ahead before maybe the rest of the market even rebounds. Okay, it might take a few quarters at least for the rest of the market to rebound when all of this kind of subsides. But I think once you see the earnings reports on these companies, these streaming services and virtual networking companies, things like that, they're going to rebound much faster. So here I'm thinking companies like Cisco, ticker CSCO. Okay, ticker Fastly, ticker FSLY. This is actually one that I bought probably about last month, maybe a couple of weeks ago, Fastly, which provides streaming services. And it's being dragged down with the rest of the market. But I think it's a great company, great long-term investment, and it's going to benefit from this increase in streaming service demand. That other company that I looked at this morning in my one of my IRA portfolios that's almost completely REITs, Digital Realty. Okay, that's ticker DLR. This is a realty company, a real estate investment trust that owns digital data centers. Right, it owns data centers, and of course passes on the profits onto investors in a pretty healthy dividend. This stock is up 13% so far this year. Now, that doesn't sound like much, but consider the rest of the market is down about 28%. That's outperforming the market by 40%, and very much a stress reliever in your portfolio. So I would definitely look at Digital Realty, some of these other streaming services and networking services stocks, and consider those for your portfolio. Also saw this morning that OPEC is estimating that developing countries could lose up to 85% of their oil and gas income this year. Okay, And besides just the hit to the energy industry that we've seen in the United States and some of those industry stocks, this is bad news for geopolitical instability. Okay, so especially countries like Iran, Venezuela, they get the majority of their government revenues and social revenues from oil. Okay, I would not be at all surprised if there is regime change in Iran, Venezuela this year. Their revenues have just fallen to zero, and they've already been suffering many years of some kind of turmoil and lower revenues with different kinds of actions and that. So emerging market stocks probably maybe not something you want to look at for quite a while. There's going to be more of that geopolitical instability, which actually probably helps the price of gold if you want to look at gold. I actually kind of like the price of oil right now, right around here. It's actually West Texas Intermediate, so WTI oil is right around $28 a barrel this morning. But I think, and that's right around where in 2006, where I made about 20,000 in futures contracts over a few months, right? If you've seen the video I did on futures, I bought the May futures at right around 26, right around when oil was at 26. I bought it for the $32 futures. Actually ended up selling for about $45 on the futures, made about 20,000 on those three contracts. So definitely some opportunities here in oil. I think you might want to wait to make any moves. I'm waiting anyway because I do see this it could go down maybe into the low 20s even with a barrel price for a barrel of oil. Another news bit I saw on the Bloomberg this morning talking about the recession. The odds of a recession have gone up. Oh, no shit. Recession is here, folks. It is here. It's going to happen. And this thing is going to get worse. So, again, I just want you to make sure you've got your strategy for when you're going to invest, how much you're going to invest, so you keep some of that cash available and take advantage of these lower prices. Again, join the community, join the Bowtie Nation here by clicking that subscribe button. Check the links in the video's description below and the private Facebook group. Got some great conversations going on there. Or just look on Facebook for Let's Talk Money Together. That's the name of the group. And let me know how you like these informal videos. Ask any questions you have below and I will get to those.